Hi there, and welcome to our webinar today. My name is Nathan Crampy. I'm a certified financial planner and vice president here at Summit Investment Advisors. And today we're going to be talking about something that's very important, our outlook for 2017, not only on investments, but also on the economy. Before we get started though, I actually want to talk about some of the areas of expertise that we hold here at Summit Investment Advisors. Now, you can actually go to our website and see a lot of this information there. You can click on summitinvest.com and you'll come to our website here. And we have a lot of information that we go through right there. And you can find some of our thought process that we have with our blog that has updates that have been going on over the course of the week, things that we have seen, things that were expectations for the week to come with the economy, stock markets, all right there. We also write white papers as well for the industry, and this also goes into depth on investments and other types of information there. So you can find all of that on our website. I did talk about the areas of expertise that we have here. Three distinct areas: financial planning, investment management, and estate planning. Now, those are the three areas of expertise, and underneath them, we drill down into four additional areas that come with that, and that's the wealth protection, wealth enhancement, wealth transfer, and lastly is the charitable giving. So all of that comes into play as we kind of wrap around our advanced plan to what suits your needs. Today, however, we're going to focus on one key aspect, and that's the investment management side. And we're going to focus on not only the investments, but also the economy and our thought process for the coming year. And to do that, I would like to introduce our first speaker for today, Russell Rogers. Russell is an advisor here at Summit Investment Advisors, and more importantly, he is in charge of a lot of the trading that happens here as well, which means he has to have intimate knowledge on the dealings of the economy, as well as knowledge of the different types of investments, and does a lot of research behind that. He has his Series 7, 63, as well as his principal license, and just finalizing his certified financial planner as well. So he has a lot on his plate, and with that, I would like to introduce Russell and let him talk a little bit more about the economy. Russell.
Thanks, Nate, for the introduction, and welcome to our webinar for 2017 Outlook. And before we get started, I want to take some time to talk about where we've been and just build some context. Kind of look back first, and then what those implications are for moving forward. So I'm going to take us back to 2015. Right, we started the year out okay. But it wasn't the best year for markets, and we gave up our gains that we had earlier in the year in August. If you remember, there was a sell-off, a 10% sell-off from the all-time highs that we achieved, and there were concerns about China's economy slowing down, and the fear that that could derail our economy as well. And then there was also a 30% decline in energy prices in 2015. But there also was a shining spot for 2015, and of course that was large cap growth stocks, and a little acronym that you can use to remember some of those big stocks is FANG, F-A-N-G, and of course those stand for Facebook, Amazon, Netflix, and Google. And so those particular stocks did pretty well in 2015. Then if we go into 2016, if you recall, that was a real rough start, and I think there were some concerns about how the rest of the year was going to shape up after that first quarter. If you recall, oil prices just dominated the storyline, and the oil prices continued to fall into that first quarter, and then we hit our low on February 11th. and that the price of a barrel of oil was about $26. And there's three things that I think need to be said about that, because that was a real major theme in 2016. One, I think that nobody expected that oil prices were going to go that low. Now, perhaps, maybe by January of 2016, you had some people coming out with these real low estimates, right? But if we look back into 2015, and energy prices actually started declining a little bit in 2014 as well. But way back, if you go back into 2015, nobody was anticipating that oil was going to drop that far, right? And then another thing, nobody expected it to play such a role that it did in our market. In particularly, stocks were trading in lockstep with oil. Oil would be up and the market would come up, and oil would be down and the market would go down. That's just kind of odd. The share price of Microsoft or Apple, and you kind of scratch your head and say, well, what does that have to do with the price of a barrel of oil? But that's exactly what we experienced. And so to put this into context, right? Oil traded at an all-time high of approximately $154 in June of 2008. And then if we look back, the national average for a gallon of gasoline, it topped out at $4.11 in July. How many of you were driving, a big SUV, maybe a Dodge Durango or a Chevy Tahoe or something like that, with a V8 engine? That was thinking back, that was kind of a big deal, right? There was a glut at the dealers, and they were just trying to get rid of these big gas guzzlers, right? And nobody wanted them. And there was some really good deals to be had, I guess, if you're in the market for one. But no, there was all kinds of focus on, looking to hybrids and some of these other, vehicles that had much better gas mileage because it cost so much, right, for transportation at that time. And that wasn't that long ago. And wow, things are quite a bit different now, of course, right, with these lower energy prices. So let's talk. I want to move to kind of the second major theme of 2016, and that, of course, was the election, right? And everything was about the election. How many of you were fed up with the election before it even finally got here and you had a chance to vote, or heard that from other people, right? We probably all heard people just saying, wow, enough already, and so that was just a huge theme leading up to it. And then of course, the implications of the election, right, on the economy. So depending on, whether Hillary Clinton won or whether Trump won, what's going to happen? And I think there are some positive things either way, and I think there was a case to be made that we're going to continue having economic growth either way. But I remember I was in Denver, and I was at a symposium, and I was listening to an economist, right? And the economist was up there, and he's kind of going through the different scenarios. And I remember specifically how he said that if Republicans maintain control of the House and the Senate, and if Trump won the election, that there would be a steep sell-off, but it wouldn't be long-lived. It'd be a short-lived thing, and we, stocks would kind of edge back up after that. But it'd be a pretty sharp sell-off. And he was kind of making the case of, the unknowns, for Trump and those sort of things. But that's not what we experienced at all. Of course, November the 8th. You probably recall, there were reports that futures were actually way down. But then Wednesday morning, the market opened up, and it just kept going up, and then the next day after that, it went up, and the day after that, it just kept going up. And so we ended the year 2016 almost, hitting that 20,000 mark. We fell short a little bit, but that's a major milestone, 20,000 for the Dow, and just ended up being a pretty good year for stocks overall. And so, I think. Well, let me highlight specifically 2016. So what really took off, right? The small caps really took off. Emerging markets did really well, and also large value stocks, right? And so coming out of that, we've got a question. A question to ask is, why did we experience that rally? It was pretty big rally, and why did we experience it? And why do we think that rally is likely to continue into 2017 and show us some additional growth in the market, right? I think two of the real big things there are policy and legislative change that was promised during the campaign, right? And two that really stand out. These two are huge. You take away some of the other economic indicators and some of the other things, just these two alone, I think are pretty powerful. Namely, lowering corporate tax rates from 35% down to 15%. That's a really big move, that's a really big change. And then also deregulation. And of course regulation is necessary, it's needed, it's we need that to protect the consumer. We need to make sure that the markets are operating efficiently and fairly. We need those regulations in place to protect the environment, but as you know, not everything always works smooth, and regulation is one of those things that sometimes it can have unintended consequences, and sometimes it can create some barriers to growth. Of course, if you're going to be in compliance with regulation, you have to allocate, labor, and resources so that you're staying in compliance with those regulations. And so, if you put yourself in the standpoint, from a CEO of a corporation, and looking ahead, your forecast for your earnings and things, and you're looking at some of your concerns and some of your overhead, and your tax liability, is of course a major cost that you have to do business, right? And so if there are indications that that's going to be drastically reduced. And then also regulation, in your particular industry, for your corporation, you have some regulation and you have quite a bit of cost associated with that. And then you have indications that those costs are going to maybe be reduced. It stands to reason that looking forward, you would conclude that, hey, our earnings, our profitability is probably going to be better moving forward just on those two items. And of course, earnings are a major driver of your share price. So I guess, looking at it, we can kind of understand why the market had that post-election rally, probably in anticipation of some of those things, and I guess we expect that to continue into 2017. So I'm gonna look at slide 2 here and start to talk about 2017 a little bit more, some of the forecast here. And so the estimate for GDP growth in 2017 is 2.5%, and that's actually pretty good, as opposed to the 1.6 that we experienced in 2016. And also one of the things I want to highlight is there's been kind of this shift away from monetary policy that's aimed at growing the economy to fiscal policy, trying to grow the economy through fiscal policy instead, kind of that shift. So monetary policy, of course, is the money supply. And the money supply, right, is controlled through the Fed and the interest rates, and then also quantitative easing, which we've heard a lot about, and that's coming to an end. That era is kind of coming to an end, and we're shifting instead to fiscal policy. And so fiscal policy is budget, right? It's spending. So government spending, and particularly the campaign promise has been from the Trump administration that he is planning on doing some pretty massive infrastructure projects rather. So, you know, your roads, your bridges, your airports, your railway systems, all these things like that, right? So infrastructure spending, and that's going to provide a boost as well. Okay, looking at the next area, international. Emerging markets overseas is showing some opportunity, and of course there's some areas of concern as well with that. Currency is a risk, right? The exchange rate between the different currencies, and then also trade deals are something we're watching. And then we look at stocks, mid single digit returns, kind of the forecast for 2017, and that's actually really similar to what was forecast for 2016, and we did reach those estimates. Improved earnings, I think, are one of the reasons why we're looking to that. We have that estimate there. Stable valuations. Scott Caskey is going to talk a little bit more later on in this presentation, and he's going to give some more detail into those items. And then looking to the bond market, you know, we see low to mid single digit returns. That's what we're expecting there, and you know, that's just kind of muted returns, and the reason for that is we're in a rising interest rate environment, and so that makes sense. I'm going to take a look at the next slide here, and we've already touched on some of these, but this is just kind of a summary of some economic stuff, and then also some of the major factors behind those. Again, 2.5% GDP growth in 2017, and you know, we're expecting 2 to 3 rate hikes from the Fed probably in 2017, and then also some acceleration inflation. We're starting to see that pick up, and you know, that's actually a good sign. The Fed is watching that. That's kind of a gauge on our growth. When inflation starts to pick up, that means, you know, the economy's heating up, and so that's good. And we think the economy is going to get a lift from steady consumer spending would be one area, improved business investment or CapEx, and increased government spending, or pro-growth fiscal policy, right? We mentioned those infrastructure projects rather, that are going to happen. And so the next slide I want to take a look at, it's kind of illustrating the drivers of GDP. And so I think, you know, you've got some different components that make up GDP, you know, net exports, and there's some different things in there. But the main thing that makes GDP move up is consumer spending. Of course, that's kind of the main one. And consumer spending is going to be steady, but we're going to see corporate investment and government spending take more of a role in contributing to that growth on GDP to get to that 2.5 estimate that we talked about. And that's what this slide is showing here. Okay, next we're going to talk about the labor market. And, you know, overall, the labor market has been continuing to improve. We've heard about it on the news, and I know there's some nuances there with participation rate and some other things, but I think the bottom line is that the labor market's improving, unemployment's low, and that's just going to help our economy grow, and so that's the main point there. Okay, looking at international stocks. So we've already touched on some of these, but improved earnings and improved fundamentals, and especially we're seeing this in emerging markets. But again, trade policy could be a concern, right? We're hearing a lot of talk about renegotiating these trade policies. The transatlantic One was already, U.S. has pulled out of that, right? And so there's some of these things are already set in motion, and so that creates, some unknown, because that's going to have an impact on that international market. Another concern might be, the debt that China is using to finance government, and so these are all things that we're going to keep an eye on and watch. So now I'm going to hand it over to Scott Caskey to talk more about the markets. Scott's a certified financial planner here, and he graduated with a finance degree from Michigan State. And Scott's also a partner in our firm. And so, Scott, why don't you go ahead and continue on, and we'll hear what you have to say there.
All right, thank you, Russell, for that introduction. And I will be taking us through our stocks and bonds and wrap up with a strategic overview for our workshop today. For 2017, we're forecasting mid-single-digit returns for the S&P 500. We expect this growth to be driven primarily by GDP growth that Russell went through with you of about 2.5%. Due to fiscal stimulus, we expect stable valuations for price-to-earnings ratio between 18 and 19, expansion in bank lending, as well as mid to high single-digit growth in corporate America earnings. Major risk to our outlook for 2017 would be a major policy risk. This chart that we're looking at here shows our returns for the S&P 500 going back to 1950. And all the highlighted years would be mid-cycle economic years. And you can see the vast majority of those are falling on the positive end of the spectrum. In years where we don't enter a recession, which throughout this 2017 year we're expecting positive GDP growth. So when we don't enter a recession, we usually have about an average gain of 12% in the S&P 500. As well as being positive 84% of the time. Consistent with that, the first year of a presidential cycle, we typically see average returns of around 9.3%, and it's positive 92% of the time. And this information is dating back to 1950. So one of our primary drivers for our outlook this year for 2017 is earnings growth. We've been in an earnings recession that started in the first quarter of 2015 and continued through the second quarter of 2016. We do expect positive year-over-year revenue and earnings per share growth in 2017, and we did have positive earnings and earnings per share for the third quarter of 2016. One of the contributing factors to our earnings decline was oil. Most people would notice that they were spending less at the pump. It was actually the first year in which I think I've ever spent less than $2.15 per gallon of gas driving. I remember when I first turned 16, I think it was around $2.15 a barrel. So first time I paid under $2 in my lifetime was during this most recent decline in prices. This chart right here talks about valuations. I'm sure you've heard on the news that valuations are high, but we don't see high valuations as a reason to sell. And the reason is because we don't see a lot of correlation between high valuations and short-term stock performance. You can see this chart has no correlation. We don't see any type of line in comparing our one-year forward S&P 500 returns and current PE ratios. So it's not a good indicator of what's going to happen in the near future. We do see, however, correlation on this chart, which is showing our S&P 500 returns versus the 10-year Treasury yield. So as interest rates rise or the 10-year yield rise, do we think that that will adversely affect stocks? Well, typically that orange line, which is a 5% 10-year average Treasury yield, you see stocks in 10-year move in the same direction or positively correlated until you reach about 5%. So today we're sitting at about 2.4% on the 10-year Treasury yield. The post-election rally, which was the largest since about 1952, we saw stocks increase pretty significantly. And while we may not have heard, the Treasury went from about 1.8 to 2.4. So we definitely saw that correlation in action with what happened with the market and the bond market over the end of 2016. So moving on to bonds, we'll be expecting muted returns for the bond market, primarily because of the interest rates rising. We're expecting 3 Fed rate hikes potentially, and we do expect the pace to moderate for the increase in Treasury yields. We expect the 10-year to float between around 2.25 to 2.75%, potential for 3%, however. So if we're expecting muted returns, we still believe that bonds play a crucial role in an overall portfolio, and this kind of shows you that relationship. Over the past 8 pullbacks we've had since the year 2010, our average decline was around 11% for the S&P 500, and over those same time frames we see bond total returns as a positive 1.6%. So you can see the significant role that having bonds has in your portfolio to take risk off the table for you. So this chart here will show us the relationship between a 10-year Treasury yield change and how that affects bond returns. So if you see as the 10-year Treasury goes up, that brings down your average return for bonds, and the more that it would go up, the more it adversely would affect bond returns. So you can see why we think moderate returns, if we're going to be between 2.25 and 2.75, that's about, potentially 0.5%. It could go up. You're seeing about a flat average bond return of 0.2%. So how do you invest in this environment? In general, your bond portfolio would have intermediate term bonds ideally, and that's just because they typically perform a little bit better in a rising interest rate environment. So your long-term bonds are most affected by the rising interest rates, while your short-term to intermediate term bonds perform a little bit better. What also perform a little bit better would be moderate credit sensitivity. So just a bit of a strategic overall view and what the U.S. economy has done over the course of time. Our long-term trend of earnings growth has been steady. So going back to around 58, you can see that 6.1% annual growth. You can see that that kind of declined recently and did decline significantly during 08. So we do expect that to rebound here in this 2016 year. Another essential indicator to kind of watch for throughout the calendar year would be a rebound in productivity. So we do think that would be very important for a better growth trajectory, as that has trended down over the recent past. So just to wrap up, the most important thing to remember is a well-diversified portfolio is important in staying the course. You can see that balanced performance between growth and value styles forecasted. We think small caps will perform better in the first half, and then large caps to come back in the second half. And then intermediate term bonds typically will perform a little bit better in a rising rate environment. So that's what I have for you, and thank you.
Thanks, Scott, and thank you, Russell, for the insights that you provided. As you can see, we are very encouraged by what's going on with the economy and also the stock market right now. And just going to give you a recap, our expectations is that we're going to have continued growth in the economy, and over time, that should grow the stock market. So with that, I want to thank you for attending. And as you have questions, you can give us a call or you can email us as well. You can call us at 651-490-2939, or email is info@summitinvest.com. Take care, and thanks for watching.